July 1st, 1944, the ballroom of the Mount Washington Hotel is stiflingly hot. Amidst the heavy smell of cigar smoke and the scratching of fountain pens, 44 nations agree to hand the world's economy over to a single piece of paper backed by gold. For 80 years, that paper was the undisputed king. Today, the smoke is cleared. The gold is long gone. In a silent office in Washington, the ink is drying on a new document, the Genius Act. The dollar hasn't collapsed. It has uploaded itself. We were told crypto was the weapon designed to kill the central banks. We were wrong. The system didn't die. It just bought the weapon. Now money is no longer something you hold. It is a network you live inside. And when your life savings become lines of programmable code, the question isn't who owns the money, it's who is holding the delete key. Money has never been about the paper in your wallet. It is a story we all collectively agree to believe in. A shared hallucination that keeps the gears of the world turning. But there is a problem. The storytellers just changed the script, and they didn't ask for your permission. For over a decade, the narrative was simple. Crypto was the exit ramp. It was the digital gold that would finally break the monopoly of central banks. We called the bankers dinosaurs, laughing as they struggled to understand a decentralized ledger. We felt safe behind our private keys, believing that code was law, and that the law was on our side. But as we move into 2026, the dinosaurs haven't gone extinct. They've just traded their scales for silicon. Look closely at the Genius Act in the United States, or the MiCAR framework in Europe. For years, the headlines told you that regulators were trying to ban crypto. They weren't. They were building a cage. Regulation is no longer a hurdle to be cleared. It has become the market architecture itself. The gates aren't being locked to keep the institutions out. They are being locked to keep the assets in. The European Union's mirror isn't just a set of rules. It's a border wall. It defines who can issue a stablecoin, who can hold it, and most importantly, who can take it away from you. The institutions realized that they didn't need to destroy Bitcoin. They only needed to wrap it in enough red tape until it looked exactly like the system it was meant to replace. The irony is dry, and it is heavy. We spent billions building a decentralized future, only to hand the blueprints back to the very people we were trying to escape. The banks aren't fighting the blockchain anymore. They are using it to hunt more efficiently. They realize that a transparent ledger is a gift to a tax collector. A programmable currency is a dream for a central planner. We used to celebrate financial inclusion, but in 2026, inclusion looks a lot like an invitation to a room where the door only opens from the outside. The absolute freedom of crypto didn't die in a market crash or a massive hack. It died quietly, in a sterile room in Brussels, on the day the first regulation was signed into law. And if the foundation of this new digital world is built on permission, then the next question is, who is the landlord? August 15, 1971. President Richard Nixon appears on television screens across America to deliver a message that would change the nature of reality for every human being on Earth. He announced that the United States would temporarily suspend the convertibility of the dollar into gold. It was a move designed to protect the American economy from foreign speculators. But in the world of high finance, temporary is a relative term. That suspension has now lasted over 50 years. In that single moment, the dollar stopped being a claim on a physical metal and started being a claim on a promise that the system would remain stable, that the debt would be managed, and that the landlord would never default. For decades, the world had no choice but to believe that promise. We lived in the shadow of Bretton Woods, a ghost of a system that functioned not because it was sound, but because there was no alternative. Then came 2008. As the glass towers of Lehman Brothers collapsed and the housing market evaporated into a cloud of toxic debt, the promise was broken. The landlord didn't just default. They printed more promises to cover the old ones. It was in this vacuum of trust that an anonymous entity named Satoshi Nakamoto etched a message into the first block of the Bitcoin network, chancellor on brink of second bailout for banks. The birth of crypto was a declaration of independence. It was a technical solution to a moral problem. We were told that we finally had a way to exit the room, to stop being tenants in a building that was perpetually on fire. But history is rarely a straight line. It is a circle. By 2026, the financial system hasn't collapsed under the weight of its own contradictions. It has simply evolved. The institutions didn't fight the revolution. They waited for it to mature. Then they moved in to acquire the infrastructure. The irony is as cold as a morgue. Satoshi created Bitcoin so that we wouldn't have to trust the banks. Today, the banks are using Satoshi's ledger to ensure we have no choice but to trust them in a way that is mathematically absolute. They've realized that a digital coin is much easier to track than a paper bill. They've discovered that programmable money is just another way of saying conditional permission. If the 1971 shock was the moment money lost its weight, then the current shift is the moment money gained an eye. We are witnessing the return of Bretton Woods, but this time the gold isn't in a vault in Fort Knox. It's in a line of code that can be frozen with a single keystroke. We used to worry about the dollar losing its value. We should have been worrying about the dollar losing its anonymity, because as the paper burns away, we are left with a system that knows exactly who you are, what you own, and more importantly, what you are allowed to do with it. If the chains of the past were made of gold, the chains of the future are made of code. And as we look at the rising digital architecture of 2026, one has to wonder if we ever actually left the hotel in New Hampshire. The ghost of Bretton Woods isn't haunting the system anymore. It is the system. And if the dollar is no longer just a currency but a gatekeeper, then we need to talk about the Trojan horse that brought it inside your phone. History does not walk, it leaps. And the leap of 2026 has a name: enforcement. For years, the digital frontier was a place where rules were written in sand. But the wind has shifted. We have moved past the era of designing policies into a cold, clinical reality of supervision. In the United States, the Genius Act is no longer a proposal. It is an architecture. If you want to issue a stablecoin in 2026, you don't start with a revolutionary manifesto. You start with a license from the Fed or the OCC. The mandate is absolute: one-to-one reserves and high-quality assets, and a red carpet for federal auditors. The irony is forensic in its precision. The motto of Silicon Valley used to be move fast and break things. In the new financial order, that has been replaced by a much quieter directive: move slowly and ask for a license. The pioneers who dreamed of a system without gatekeepers are now queuing up at the gates, balance sheets in hand, hoping for a stamp of approval. This isn't just an American story. Across the Atlantic, the European Union's McCarr framework has reached full implementation, turning 27 nations into a single synchronized cage for digital assets. The transition period is over. In Singapore and the UAE, the sandboxes are closing, and real-world supervision is beginning. The system has realized it doesn't need to ban the technology to control the money. It only needs to define compliance, so narrowly that only the largest, most entrenched institutions can survive. If you do not comply, you are liquidated into the dark corners of the internet where liquidity goes to die. If you do comply, you are no longer a revolutionary. You are a module in the very infrastructure you once sought to disrupt. The air is getting thin. As regulators clarify how digital assets can be used as collateral, the line between a crypto token and a traditional security is blurred into irrelevance. The system loves the truth of the blockchain, especially when it can use that truth to track every move you make under the guise of consumer protection. The gates are closing, and the rules are no longer up for negotiation. But while the major powers synchronize their watchdogs, a new kind of shadow is beginning to stretch across the map. Because when every dollar is a tracked and programmable unit of code, the world doesn't just get safer, it gets smaller. And in a world this small, the question is no longer which coin you own, but which zone you are allowed to occupy. A king with too many borders is eventually nothing more than a high-ranking jailer. We were sold a dream of a borderless world, a singular digital ocean, where capital could flow as freely as information. But by 2026, that ocean has been partitioned into a series of highly regulated, walled-off reservoirs. The reality of the market is far from flat. While the US dollar dollars to perk, theoretically dollar has successfully converted its hegemony into a digital network. Other powers have no intention of remaining mere spectators in a market they believe they should help shape. Across the globe, jurisdictions are exploring stablecoins denominated in euro, yen, and multi-asset baskets. If successful, these digital currencies won't just compete with the dollar, they will fragment the existing ecosystem into parallel monetary zones, reducing the reliance on American policy. The industry is moving from the phase of policy design to a fragmented reality of local enforcement. We have global crypto, but local rules. In Japan, the law dictates that only banks can issue these assets, while in the United States or the EU, some non-bank entities are invited to the table, provided they have the right pedigree. Singapore and the EU demand nearly instant redemption, while others debate more flexible delays. The irony is as cold as a data center. We dreamed of a single global currency for the Earth, a way to finally transcend the limitations of the nation-state. What we received instead is a labyrinth of compliance regimes, where your wealth is defined not by how much you have, but by where you are standing when you try to spend it. This fragmentation isn't an accident. It is a feature of a system that prizes control over efficiency. When every region builds its own rails with its own specific transaction privacy and interoperability rules, the global nature of crypto becomes a technicality. Smaller players are being squeezed out, not by a lack of innovation, but by the sheer weight of multi-jurisdictional red tape. You may hold a coin that is perfectly legal in London, but find it is functionally frozen the moment you attempt to move it to a wallet in Paris under McCarr's strict oversight. We didn't end the reign of the central bankers, we just gave them a more precise set of borders to defend. As the map of the digital world divides into these parallel zones, the distance between them is growing. We are entering a time where money is no longer a universal constant, but a regional variable. And as these borders harden, we must look at how this new reality is quietly creeping into the one place you thought was still yours. The cage is no longer around the currency, it is being built around the user. You don't need to buy a single Satoshi to be a player in this game. In fact, you entered the arena the moment you tapped your phone to pay for that coffee this morning. For years, we looked at the blockchain as a distant laboratory experiment, a playground for speculators and tech anarchists. But by 2026, the laboratory has expanded to include your checking account. The walls of the digital cage are not made of iron, they are made of tokenized deposits. Traditional banking used to be a world of slow, opaque ledgers, a place where money sat in a vault of bureaucracy. But under the new architecture of the 2026 financial pivot, banks are quietly converting your balance into programmable tokens. It's a seamless transition, so smooth you'll barely notice the difference in your banking app. But beneath the surface, the physics of your wealth has changed. Every dollar you own is now a data point on a high-speed, interoperable rail. It is money that can think, money that can be tracked, and most importantly, money that can be conditioned. When your savings become code, they are no longer just a store of value. They become a permanent record of your behavior. The system calls this transparency. It's a beautiful word, often used to sell the promise of a safer, fraud-free world. But in the cold light of forensic analysis, we have to ask, transparency for whom? Is the system becoming transparent so you can see how power works? Or is the system becoming a mirror so it can see exactly how you work? The irony is dry and clinical. We spent a decade demanding that banks become more efficient, more digital. We got exactly what we asked for. But efficiency is a double-edged sword. A system that can settle a cross-border payment in seconds is the same system that can freeze an unauthorized transaction in milliseconds. In this new digital cage, privacy is not something you lose. It is something that no longer exists by design. Every purchase, every subscription, every transfer is etched into a ledger that never forgets and cannot be erased. We are moving into a world where your financial history is not just a document you provide to a lender, but a real-time feed that defines your social and economic eligibility. The industry leaders talk about responsible innovation and consumer protection, but protection always comes at a price. In 2026, the price is the anonymity of the individual. As the dollar, the euro, and the yen become programmable units within these regulated networks, the distance between your private life and the central authorities disappears. You aren't just a customer anymore. You are a node in a vast, state-sanctioned surveillance architecture. Take a moment. Think about the last thing you bought that you didn't want anyone else to know about. In the world of 2026, that secret doesn't exist. It is a line of code, waiting to be audited. The digital cage is comfortable. It is fast. It is incredibly convenient. But as the gate clicks shut, we realize that the most dangerous traps are the ones we walk into voluntarily because they make our lives easier. We've reached the final layer of the architecture. The dollar has been uploaded, the regulations have been set, and the cage has been built. All that remains is to see what happens when the landlord finally decides to turn the lights out on the old world. Convenience is the most potent anesthetic power has ever invented. We accept the surveillance because it makes the transaction instant. We accept the cage because it is painted in the colors of efficiency. By 2026, the global financial system has achieved something the kings of old could only dream of. A machine that operates with such frictionless perfection that you never even realize you're being steered. This new architecture is undeniably effective. Money now moves across borders at the speed of light. Settlement risk has vanished, and the costs of participation have plummeted. But in the world of high finance, nothing is free. The price of this efficiency is the total surrender of individual unpredictability. In a system built on programmable code, there is no room for the human error of privacy. The irony is as cold as the servers running the ledgers. We spend our nights fearing that AI will one day rise up and rebel against its creators. But we should be far more terrified of a financial system that is so perfect, it no longer allows for a single mistake. A world where your ability to transact is tied to a real-time compliance score is not a world of freedom, it is a world of managed participation. The regulators tell us this is about resilience and stability. They promise that these digital rails will prevent the next 2008, that they will catch the criminals and protect the vulnerable. And perhaps they will, but a system strong enough to protect everyone is also a system strong enough to exclude anyone. When every dollar is a smart contract, the landlord doesn't need to send a bailiff to your door to evict you from the economy. They only need to update the permissions on your digital identity. We used to celebrate the blockchain as a way to be your own bank. In 2026, we've realized that being your own bank just means you're now the one responsible for maintaining your own digital cell. The institutions didn't fight the technology, they simply optimized it until the revolution became a feature of the status quo. Take a long look at the world we are building. The system isn't malicious. It isn't fueled by a cinematic conspiracy or a hidden cabal. It is simply a machine designed to be as efficient as possible. And in a machine that values total order, the individual is always the most inefficient part of the equation. The gate is no longer a physical barrier. It is a logic gate. And as the final lines of code are written into the global monetary standard, the exit ramp we were promised has become the intake valve for a new kind of rain. The lights of the old world are flickering, and as the darkness grows, we have to look at what remains when the smoke of the digital revolution finally clears. We often look for the big collapse, the cinematic moment where the dollar bill burns and the banks close their doors forever. But power rarely disappears, it just changes its form. In 1944, at the Mount Washington Hotel, 44 nations signed an agreement believing they were creating a permanent order. Today, in 2026, we are signing a new silent treaty with technology. The reign of the paper dollar is indeed ending, but the dollar itself is not dying. It is simply shedding its skin to become an invisible global network that covers the earth. We were promised that crypto would be the exit ramp from the old world. Instead, it has become the architecture for a system that is more pervasive and precise than any king or central banker could have imagined. If you value these historical deep dives into the mechanics of power, leave a number 1 in the comments and subscribe to Financial Money History. Don't ask when the dollar will collapse. Ask yourself this: when money becomes a line of intelligent, programmable code, will it still serve you? Or are you now the one serving it?